The pace at which wages are increasing is slowing, potentially giving the Bank of England more confidence to make further interest rate cuts this year. Pay, excluding bonuses, grew by 5.4% in the 3 months to June, which is less than the 5.8% a month before. Data from the Office for National Statistics showed employment is up and the rate of unemployment unexpectedly dropped to just 4.2%. Well, Ian King is with me now to pick through this. So what does this mean, Ian?
Well, essentially, Jane, this is pretty consistent with the overall messaging that we've seen in the economy. The economy is pretty resilient right now. The UK was the best performing economy in the G7 during the first half of this year. And the labour market is pretty tight. That's what these wage increases are showing you. Now, wage inflation has come off the boil slightly, but at 5.4%, that is pretty high compared with where it has been over the last few years. And when you weigh it against the headline rate of inflation, of course, it means that wages have been rising now above inflation for more than a year. Now, there are various distortions into whether or not you take into account bonuses. When you include bonuses, the drop was actually sharper to 4.7%. That reflects the fact that a year ago there were some big one-off bonuses paid to NHS employees. But that headline figure of 5.4%, I think, is probably higher than the Bank of England would want to see right now. And elsewhere, I mean, some really interesting things going on. You mentioned there the fact that the headline rate of unemployment fell from 4.4 to 4.2%. Well, the market was actually expecting an increase to 4.5%. Now, there are discussions to be had as to the accuracy of the labour force survey data compiled by the Office for National Statistics, and that's certainly an element. But again, it points to a fairly robust labour market. Now, vacancies are interesting. They fell for the 26th consecutive month, 884,000 vacancies still in the economy. That is still way above where it was pre-pandemic. So again, we know that there's a skill shortage in the economy. The Chancellor's talked about it a lot, as did Jeremy Hunt, her predecessor. And it's really consistent with the messaging we've been getting there. The other really interesting thing is inactivity. Again, something Rachel Reeves is very exercised about. This is the number of people of working age who aren't in work. Some of them are students, some of them are carers. 22.2%. That's nearly 1 in 4 people of working age not in work. And again, this all points to the tightness in the labour market.
So what about interest rates? A lot of people who've got mortgages will be looking at this and thinking, is this going to make a difference?
I don't think in the short term it's going to be very easy for the Monetary Policy Committee to justify cutting interest rates again this month. They obviously went for the first time since the pandemic last month. But I think back-to-back interest rate cuts would probably be a bit of a stretch when you look at the level of wage inflation in the data. If you take what some of the MPC members have been saying, Catherine Mann, for example, gave an interview to the FT yesterday where she said she was still concerned about inflationary pressures in the economy. And we'll see that tomorrow. This time tomorrow we get the inflation numbers. We're expecting a tick up in the headline rate of inflation from 2% to 2.3%. So that makes it hard for the MPC to go just yet. I mean, the market is still pricing in another rate cut this year, but it's probably not going to be until November. And certainly if you look at the way the pound reacted this morning when these jobs figures came out, sterling rose. That tells you that the market is assuming that rates are going to stay on hold for a couple of months at least.
And you touched on inflation. I mean, could it go, it's potentially going to go back up, isn't it?
Well, it certainly will, yes. I mean, for very good reasons. What economists call base effects, which is where you're looking at the year-on-year comparison. And this time last year, prices were falling quite rapidly. So the year-on-year comparison means that there is probably an increase in inflation baked in. As I say, 2.3% is the number the city is looking for. And bear in mind also, we had some interesting grocery inflation data today from Kantar World Panel, big analysis of till roll data that they do every month. And in the 4 weeks to the 2nd of August, grocery price inflation was up by 1.8%. That's the first time that we've seen grocery price inflation rising for more than a year. Now, that's only certain parts of the basket. There are some commodities, toilet paper, dog food. Prices there are falling, but there are certain other items in the basket where prices are going up. Vitamins and minerals is one. Another one, confectionery. There's been a big rise in the wholesale price of cocoa, and that is feeding through to higher prices in some lines in the shops.